Okay, welcome everyone to today's session on the evolution of crypto-asset taxation. Crypto-asset tax transparency continues to challenge regulators, businesses and customers alike. Our aim for today's session is to provide useful information from experts and professionals in the industry to further inform the community as to such areas as responsibilities, issues to consider and some of the interesting nuances surrounding crypto-asset taxation. Today's session is hosted by CryptoUK. I am the chair of CryptoUK. My name is Ian Taylor. Welcome everybody. We are the UK's trade body for crypto assets. We are pleased to host this event today, which is sponsored by new executive members, Binance UK. Today we will hear from a number of panelists, including academia, HMRC, and a representative from the industry. So let's move on to our panelists. Firstly, I welcome Dion Seymour from HMRC. He will focus on the current and future guidance for both individuals and corporates, and we'll also discuss the ongoing internal training they do to ensure their staff understand some of the issues UK taxpayers have. Then we'll pass over to Josh Goodbody from Binance, who will focus on some of the issues affecting institutional crypto tax. Then we'll hear from Shukry Haleemdeen of My Accountancy Team Limited, trading as www.mycryptotax.co.uk. Shukry will discuss some of the more frequently asked questions around crypto-asset taxation in the UK. And then we'll hear from Mitchell Stein, who is Associate Professor of the Ivey Business School, Western University in Canada. And Mitchell will focus on meeting the global tax transparency challenges of crypto assets and draw from some of the research he has done around the OECD's initiative to tackle base erosion and profit sharing. Well, welcome everyone. Thank you so much for joining us today. If I could perhaps start with Dion to give a brief introduction of yourself, please.
Oh, thank you very much, Ian, and thank you very much for the invite to come and talk. So my name is Dion Seymour. I'm the policy lead for crypto assets within HMRC. I've now been involved in this area for about 3 years, and always look forward to these kind of conversations because there is a very interesting developing market with crypto assets and how that interplays with tax. And so very much welcome this opportunity to talk about tax in this forum.
Thank you, Dion. Can I ask you to introduce yourself, Josh?
Yeah, sure. Thanks, Ian. Thanks for hosting and having us. My name's Josh Goodbody. I'm the Director of Growth for Binance. I'm based in London and I lead the Binance UK business here. Tax is extremely topical for us as a business as we continue to kind of expand our products and services locally. And we're always looking at barriers to entry in the market. So for us, tax is a really important topic to kind of give a little bit more clarity to our community and really push things forward as an industry. And as far as we can, debunk some of the common myths that are out there. So really pleased to be here and looking forward to jumping in.
Thank you, Josh. And over to you now, Shukry.
Hi, thanks Ian for the invite. I'm sort of director of a small boutique accountancy firm focusing on cryptocurrency taxation. So we have substantial clients on this space. So I'm happy to share my experience and some of the questions raised by the clients, individual clients in the UK regarding cryptocurrency taxation.
Thank you for that. And over to you, Mitchell.
Thanks Ian for inviting me to discuss a little bit about the academic perspective and the broader, I guess, global perspective around cryptocurrencies and taxation. My background is, as you mentioned, I'm an associate professor at the Ivey Business School at Western University. And I actually spent the first half of my career in public practice at Deloitte in the tax world. So sort of have both angles and try to integrate that within what I do. I teach accounting at the Ivey Business School. My research focuses around issues of regulation and transparency, both within accounting and taxation. And as you mentioned, we did this recent work on the OECD's work on base erosion and profit shifting, and looking at the taxpayers' risk. So hopefully, and currently looking at sort of extending that into broader technological areas and impacting taxation. Looking forward to the discussion.
Thank you. Mitchell, and thanks to everyone for introducing themselves. So the way we're going to work this session today is we're going to give each of the panelists 5 or 10 minutes to just go through some of the issues they're seeing in their roles and in the industry at large. And then once we go through all of the presentations, we'll come to some questions which were posed by our community members in the industry at large. And then we'll get into a nice debate after we've had the presentations. So if I could hand back to Dion to start with your session. Thank you.
Thank you. So thank you, Ian. I'm going to start with a quick overview on HMRC's position on crypto assets. And as a starting point of the conversation, you'll note I use the term crypto assets rather than cryptocurrency. Although both terms are used interchangeably, they're not quite the same. Crypto assets is more of an umbrella term that encompasses much more than just, say, Bitcoin. It's arguably, in our view, a more accurate term. We're also finding more and more other bodies are also starting to use this term as well. As a starting point, I wouldn't say that there isn't a specific crypto tax as such, and existing legislation continues to apply to this asset class. That doesn't mean that there isn't a tax on crypto assets, more that it will continue to fit within the current framework that already exists for all other types of assets. Internally, we have developed a number of e-learning products to build awareness and training to our staff, and we've had presentations given by industry leaders on the development of crypto assets and the crypto asset ecosystem and large. Obviously for us, the challenge remains how to keep pace with all the developments that occur here. And it is a fast moving and fast developing sector, which has implications for all heads of tax. The tax treatment of crypto assets continues to develop due to the evolving nature of the underlying technology and the way that crypto assets are actually used. Obviously, last year, the big announcement of Libra took the media by storm, and this year it's been the development of stablecoins and CBDCs, which have been increasingly referenced. Although I don't want to get drawn into a conversation or discussion as whether those are actually crypto assets during this presentation. We've also seen an increase in decentralized finance, DeFi, over the summer, and the increasing number of NFTs, non-fungible tokens, that are becoming available. So, you know, considering that just over 10 years ago, this all started with just a single type of crypto asset with Bitcoin, it's quite incredible to see how far we've gone in quite a short space of time. In addition to our education activity, which is both internal and external, HMRC will obviously take action to check that customers are managing their tax obligations correctly. HMRC will regularly use the powers provided by Parliament and gather data from a range of other sources to ensure that people are complying with those that don't seek to comply with their tax obligations. Data collected by HMRC is also used to obviously improve the integrity of our tax system and to help us develop any new ways, possible ways forward for the treatment of crypto assets. We want to help people get it right. And crypto assets is a complex topic, and it is quite different from traditional assets. It's fair to say that in the world of tax and technology has become joined in quite an interesting way. HMRC has published a number of guidance papers to assist customers and agents understand our view on the taxation of crypto assets. And the two main papers that we have released have focused on individuals and businesses, but primarily those that we could term exchange tokens, so the more Bitcoin type tokens. We're focused on those not because they're easy, but obviously they still represent the mainstay of the crypto asset market. And again, although I reference that we have had increasing number of developments with DeFi, stablecoins, NFTs, and so on. All our guidance papers are available currently, as shown here, on our website, Government Publications Tax on Crypto Assets. The first one was published actually dating back to the end of 2013, or what's called Revenue Brief 914. The crypto asset market, as I've said, the world has moved on since then, And so we updated our guidance on the 19th of December 2018 with the individuals paper, which was also subsequently updated in November 2019. And then we've also released the Crypto Assets Tax for Businesses, which was released in the December 2019. As I mentioned there, HMRC, we can continue to keep guidance under review, and further updates are planned to be released soon. Apologies. Right. I also want to tackle some of the misconceptions that we see here and just state what HMRC's view on some of these actually are. So crypto to crypto transactions are taxable. Some consider that crypto assets are only taxable when they get converted back to a government-backed currency, also called fiat, from the sale of a crypto asset. However, that is not the case. The sale of on disposal of one crypto asset for another, so let's say Bitcoin to Litecoin, is actually a disposal for capital gains purposes. Each crypto asset needs to be kept in its own separate pool for what's called Section 104. And this is actually there to simplify record keeping requirements. The next one is crypto assets are not a currency. And it's important to recognize that the UK government has not recognized any crypto asset to be a currency. HMRC, in line with the rest of the UK government, consider that crypto assets, specifically the tokens themselves, to be assets. There seems to be little question that crypto assets can be considered to be property. And some have commented that if we call these things cryptocurrency, then somehow the taxation outcome would be actually different. It should be noted that other currencies, such as sterling or the euro, are also considered to be an asset. And it's actually only sterling that isn't considered in the UK to be an asset. So essentially, even if we did call these cryptocurrency, the end result would be somewhat the same. The acquisition of crypto assets is not the same as gambling with crypto assets. This is a misconception that we have seen from a misunderstanding from our first guidance, which we released in 2014, which people seem to think that we said that crypto assets or the acquisition of crypto assets is gambling. Hasten to add, gambling is a question of fact, and we certainly do not consider that the buying and selling of crypto assets to be the same as gambling. And if you're paid in crypto assets, this is similar to being paid in other types of non-cash assets. So equally, we already have existing legislation that states that if you are paid for your employment as an employee or a director in a non-cash asset, then that is actually still chargeable to income tax and or pay and national insurance contributions if required, and require operators to operate PAYE when they provide remuneration to their employees in this form of crypto asset. So it is still chargeable regardless is it being a crypto asset. I'd just like to close this little intro just to note some of the wider activity that's actually going on. And as time has continued, we are seeing more and more activity from not just wider UK government, but also from much further afield. So the Financial Conduct Authority, the FCA, have been appointed the regulator for virtual asset service providers under the first money laundering directive. They've also made a recent announcement about the sale of certain financial products, mainly derivatives, in regards to retail customers. And they've also been very active in consumer research, and they've released consumer research for 2 years in 2018 and 2020. HM Treasury have also been quite active, and they've recently closed a consultation on the financial promoters order. The Bank of England have continued discussions on the opportunities, challenges, and design of potential CBDCs. And not least to mention our colleagues at the OECD, who have recently published a paper to give an overview on the different tax treatments and the emerging tax policy issues around what they termed in the paper as to virtual currencies. So it is a very active and very developing space. So on that, Ian, can I hand back to you?
You sure can. Thank you ever so much, Dion. That was a very informative and interesting presentation. And just to your point around the guidance that the HMRC published last year, I would urge anyone in the space who has any queries, questions to take a look at that guidance. It's also on the CryptoUK website, which is at www.cryptouk.io. We'll come into some of the issues you raised, the question session, Dion, around some of the activities that are taking place in the regulatory space in the UK. But I think now, if I may, hand to Josh to discuss some of the institutional issues. Thank you.
Absolutely. Okay, guys, I'm just going to share my screen. There we go. Hope you can see. All right. So, as I mentioned, we are coming at this from the perspective of Binance UK. So everything that I'm going to talk about now is very much from the lens of UK consumers, and really where we're seeing a lot of confusion is really down to the asset class and the product suite. It is as Dion mentioned, a very complicated space with products and services coming out every single day. And as we, as a group, as a business, go around the world speaking to participants, there's an increasing amount of confusion as to the tax treatment of crypto assets, both at a retail and an institutional level. And I think, frankly, that's simply because there's so much happening in the space that makes people think that the tax regime in some way, shape or form needs to change with it, when actually the existing tax regimes in the majority of, for example, European countries already applies as it always has for the past few years. So there's a lot of myth busting, I think, that we're seeing as a group at a global level. So before I dive into specific institutional insight, I'm just going to talk a little bit about our group and tell you why we believe that we're able to abstract some kind of key themes here. So the Binance ecosystem is very, very diverse. The business is just over 3 years old now. We celebrated our 3rd birthday in July this year. And over time, we've gone from really just having a core engine for our business, which was our spot exchange, to having all these different products and services at a group level. And this is all accessible on Binance.com. Now, we see Binance.com as an ecosystem of different crypto asset products. And as you can see, just from a glance here, they are very diverse, very different. They have specific qualities to them that are quite distinct and unique. And so for the average consumer, this, of course, is quite daunting when you're interacting with this ecosystem, understanding exactly what your associated tax obligations are with this. So that's just a general theme we see. The complexity of the product, unfortunately, is probably a primary cause for confusion in this space. But as it applies to institutions, which is the area that I really want to focus on, we as a group have been speaking to institutions globally for the past nearly year and a half or so, and that's really understanding, or at least trying to understand, the key drivers for why institutions are entering the space. Why are they increasingly getting involved? And in doing so, we learned a lot about what their sentiments are related to all areas of their business. Tax obviously being one of the core areas of concerns that they have, and one of the barriers that we continue to see as we build businesses locally. Now, as you may or may not know, we are building a UK business. Binance.UK is a product primarily designed for UK consumers. It is still being built. We're in the process of putting together a crypto asset exchange with both crypto to crypto and fiat to crypto functionality. And so in doing so, we've reached out to the community and specifically institutions and said, what do you need? What are you looking for? What kind of features are key for you in participating and trading on our exchange product? And so we've garnered a lot of feedback from them as we've put together our product suite. So I'm going to dig into just a few today because I don't want to take up too much time going on each kind of granular concern or theme. But these are some of the core areas I want to touch on. So in terms of global adoption from an institutional perspective, in the third quarter of this year, we saw a 60% increase in institutional clients onboarding onto our global platform, Binance.com, versus quarter two. And that's a massive amount. We've never seen such a high increase in institutions getting on board. And of course, with that comes the associated questions and concerns that they have related to tax. And we would put tax in the kind of top 5 of the key themes that we identify when we speak to institutions around things that they really need to be focusing on and understanding in the ecosystem. A large amount of these institutions are European-based, and within that, of course, there is a subset of UK-based institutional clients that really want to interact with our UK exchange when we get that up and running. When you compare that versus quarter 4 last year, it's in terms of our total book of institutional clients, we're up 49%. So it's a very large increase. And there are various reasons why we're seeing this. The increase in kind of speculative activity in the trading markets, prop shops, hedge funds entering the markets, long-term investors as well, whether that's individual investors or even asset managers as well, increasingly seeing Bitcoin as an interesting store of value. And of course, that comes with treasury management being a key narrative within the space, i.e. holding certain crypto assets, Bitcoin in particular, as a hedge against the increasing kind of devaluation of fiat currencies. Now, with that in mind, that is kind of a very broad brush set of use cases there that we're seeing on the institutional level. And as we understand that and try and apply that to building our business in the UK, we sat down with them to understand what we need to be doing from a service provider perspective, from a business perspective, to be able to give them the products and services they need to be able to trade and interact with the crypto asset marketplace and meet their tax obligations. So, a key theme being transparency of trade information, of their asset holdings, finding smart ways to integrate with service providers via API, or being able to download CSVs of your activity. So having a core focus from an infrastructure perspective to be able to enable these institutions to meet their tax obligations has been one area that we've really seen a lot of interest in. And the space has developed quite significantly, and I'm sure my fellow panelists will talk about this in a bit more detail, but people have gone from doing manual reconciliations of their trade positions and their account balances to actually looking increasingly to automate these things and pull their trade information out and process that via frequently third-party systems. So building our core product with tax obligations in mind has been one of the areas that we've sought to kind of canvas institutional community opinion on, and that's gone down very well. Now, stepping back and looking at the underlying product suite, the challenges that we see institutions facing relate to the actual underlying products. So as Dion mentioned earlier, the emergence of DeFi as a segment within the crypto asset market has thrown up all kinds of questions as to how these different systems, whether they are trading systems, whether they are decentralized liquidity venues, these new kind of functions and systems that are operate in a decentralized manner. Traditional finance functions are not built to at least understand these or keep up to date with them. So we've seen the scale and pace of innovation be a continual challenge in finance and tax functions, being able to keep up to date with how to deal with those products and services as it relates to institutions' tax obligations. And the underlying product complexities around this require a lot of due care and attention. So what we're seeing from institutions is increasing interest in getting people either as advisors or bringing them in-house who understand how to problem solve creatively and think around all the challenges that arise related to this quite complex product suite. So DeFi, again, just going back to DeFi, there are all these varying concepts within DeFi, like, for example, liquidity farming. You know, how do you constitute income that comes from farming activities? The returns can be volatile. Sometimes you have to claim them. Other times you get them automatically. How do you account for that? That's an area of real kind of concern and confusion frequently for institutions. And then there are protocols that operate things like automated market makers. And essentially what that constitutes is you staking or providing your assets into a protocol that operates an automated liquidity function. So you place your, for example, Ethereum into an automated market making protocol, and that protocol then will, with your balance, a pooled balance of all participants, will be able to provide liquidity to participants that come in and say, want to buy Ethereum from the pool. So there are associated reward mechanisms within that. So the income that's generated from that, a lot of these institutions are trying to grapple with how to really how to treat that and how to classify that. Now, I think all this comes down to education and comes down to getting as much knowledge and spreading as much information around resources that are already available in many cases, as Dion alluded to. I think that's one of the areas that we as a business see ourselves as holding a key duty and a key role in that. We as a business have always had a mindset around education. So we've had something called Binance Academy, which is a key educational tool that we use to create tools, content, and material for the community. You know, extremely broad brush down to granular protocol specific educational material. And we also have a research arm that does research that we think has, you know, educational qualities to it as well. So, you know, where we're coming at this as a business, where we're coming at this from is we see a duty in kind of increasing the amount of information that's out there for our institutional participants and helping bridge any gaps in information that there might be there. So what we'll be focusing on next quarter and throughout 2021 is trying to create as much momentum in terms of information and educational content to try and narrow down as many of the existing gaps that there are in knowledge as it relates to kind of the institutional tax space. So I hope that was a snippet on some of the sentiment that we're seeing at a global level. We're obviously very keen to engage with the community on these kind of topics. So I think that kind of covers the long and the short from my side. And I'm very happy to dig into some of that in our panel later on. Thank you.
Thank you, Josh. Thank you, Josh. Appreciate that. It's very informative, and we welcome Binance in the UK and the great work you do in the community and along with policymakers and regulators alike. And I just wanted to pick up on the very interesting quantitative data you provided regarding the increase in institutional involvement that you've seen across your platforms. And this feeds into the qualitative data that we get at CryptoUK, that this year, 2020, and for sure next year, will be the tipping point for institutional involvement. And we know that comes from the regulatory clarity that we'll dig into in a little bit after we finish with our presentation. So if I may pass over to Shukry to discuss some of the issues that you're seeing on the sort of retail individual basis in the UK.
Thank you, Ian. Let me share my slides. Okay. Yeah, so I plan to sort of focus on some of the common questions asked by our retail client on a daily basis. So the first question I choose, what type of tax I do need to pay in UK for cryptocurrency? So the type of tax what you need to pay depending on what type of activities you are doing within crypto. So primarily, if your activities deemed to be investment, it will become under capital gains tax regime. Whereas if your activities are constituted as a trading activity, then the income tax and national insurance will be relevant on the trading profit. Whereas if you have any non-trading income generating activities such as like mining, staking and lending and pooling, these will be come under the income tax as a miscellaneous income, so whereas only you will pay income tax rather than natural insurance on these income. And similarly, what Dion alluded to earlier, if as part of your employment, if you've been provided any token, that will be considered as employment income under the readily available convertible asset. So the employer has to consider as a PAY income, and they need to pay the employer NI and the employee NI on the token market value what they have sort of given to the clients. We have seen this is very common among cryptocurrency startup companies, where they sort of give a token as a part of their remuneration package. So that's something you need to consider. So in terms of cryptocurrency, as Dylan mentioned, it's been treated as an asset. So the inheritance tax is relevant as well. So if you are sort of transitioning your asset to your next generation, you need to consider the inheritance tax implication on these. From a VAT and stamp duty perspective, any cryptocurrency investment trading is outside the scope. However, if you are providing any service and getting paid in crypto, still the VAT is applicable on your service invoice, what you are charging on your client. So you need to sort of understand and make sure that if it is relevant, you need to apply the relevant VAT rules on your invoicing. So in essence, it's not one type of tax relevant for everything. So we need to look at individual situation, and based on that, we need to determine what is the relevant tax. And based on that, we need to sort of use the specific rules to calculate the tax for meet the individual circumstances. Okay. Moving on from there, my second question is, okay, when do I have to report my activities to HMRC? So in terms of determining your tax liability, first we need to determine whether what is your UK tax residency. If you are a UK tax resident, your worldwide income need to be declared in UK. So even if you have using any cryptocurrency exchange based in overseas territory, still this will be a part of your UK tax submission requirement. So you need to consider that to include in your tax return. And in terms of reporting criteria, if you have income, trading income more than £1,000 during a tax period, then you need to report these activities. In terms of non-trading income, if you have more than 2,500 during a tax period, you need to declare these activities to HMRC. From a capital gain perspective, if you have a chargeable gain during a tax period more than your tax-free personal allowances, it is a requirement for you to report your activities. And in certain situation, even if you make a loss or a gain below the threshold, still you need to report. For example, if your disposal proceed during a tax period is 4 times your personal allowances, even if you make a loss or gain below your tax threshold, still you need to report your activities to HMRC. So you need to sort of ensure sort of look at your activities to make sure you are reaching the chargeable gain threshold, so that you could declare your gain to HMRC. Some of your common misconception which Dion addressed as well, a lot of people still not convinced that crypto to crypto is taxable event. So that's something need to sort of address. Not required to report any losses. As I mentioned, if your disposal proceeds exceed the reporting threshold, that you need to require to report that as well. And again, reporting your backdated tax return. For some reason, a lot of people assume that HMRC only introduced or interested in cryptocurrency recently. So if you have any gain related to previous tax period, you don't have to consider these. However, as for cryptocurrency, there is no new tax legislation. So everything is based on the existing capital gains and income tax rules, which was prevailing since 1992, the primary capital gains legislation. So we've been using similar principles, sections 104 for pooling and 30-day rules for other assets such as share taxation. So these principles are already established, and you need to follow these rules. If you have any gain related to prior tax period, then either you could make an amendment to your tax return and report these activities, or you can utilize HMRC worldwide disclosure facility to bring your tax up to date. So once you notify HMRC of your intention to make a disclosure, you will get 90 days period to report and pay the taxes, bring your tax affairs up to date in terms of your previous tax period. And my third question is, okay, what happens if I fail to declare my activity to HMRC? So there is a penalty regime in place in terms of failure to notify any chargeable gain or income, and also if you have submitted any inaccurate submission to HMRC. So the penalty will be determined based on the type of behavior which HMRC deem cause these errors. Generally, each individual is expected to take a reasonable care in terms of their tax affairs. What that means is you need to keep appropriate record keeping and calculate your income or gain and notify HMRC and pay the tax on time. If failure to do any of these will result in penalties, and if you haven't taken reasonable care, your behavior will be deemed as careless behavior. If your behavior is deemed careless, HMRC has the powers up to 6 years to go back and investigate the tax affairs. And in terms of penalty, it could range from 10% to 30% for careless mistake or notification. And third and fourth type of behavior is deliberate and concealment. What that means is if you knew that you need to report your tax activities, but still you haven't reported, or you have taken effective measures to hide your affairs, then this will be considered as a deliberate concealment. In that scenario, HMRC has up to 20 years to go back and investigate the tax affairs. And in terms of penalty, it can range up to 100%. Sometimes, if it is considered as offshore tax avoidance, it could range up to 200% penalty on the outstanding tax payable. And also, we need to sort of look at the voluntary disclosure and prompted disclosure. So when HMRC charging penalties, if you come forth and trying to correct your tax affairs, it will be looked at as favorable, and you are taking the initiative sort of correct affairs. So they will go for these sort of minimum penalties. Whereas if HMRC from various means found out that you have a taxable gain that you haven't declared, then this will be considered as a prompted disclosure. And in that scenario, the severity of the penalty will be higher. So it's always go for the maximum ban in terms of the penalties. And also, as Dion mentioned, HMRC has the power to sort of collect information to constitute tax investigations into tax affairs of an individual. If you look at last budget, it has been sort of announced that the government is kind of allocating substantial funds to target tax evasion and tax investigation, so that they can collect up to 1 billion additional revenue from tax investigation. So yes, HMRC has increased the focus on tax investigation, and already HMRC received a lot of information from various sources, such as they have the capabilities, systems such as Connect, data mining facilities. They get data feed from all banks and financial institutes. And plus, as part of the automatic exchange information, more than 175 countries exchange financial information about tax residents. So these information will be used for tax investigation. So this could result in higher penalties. So always sort of best to take the initiative and report the affairs on a voluntary basis. That way you could make sure that you are minimizing your exposure to any substantial penalties. There is kind of misconception that unable to track the crypto activities. So if you know how the blockchain works, that's the kind of beauty of blockchain. So underlying technology have the capability to sort of look at all the history. So public ledgers are freely available, anyone can access. So even a regulator doesn't have to have additional information request to look at this data. So it's freely available. They can sort of look at the data and look at the history, and based on that, they can sort of monitor any tax avoidance. And as part of the money laundering legislations, from January this year, the regulation has been extended to include cryptocurrency exchanges and service providers and custodian service providers. What that means is they will be start doing KYC on all crypto investors. So that will enable to pinpoint the individual users of these wallets, and also as part of the money laundering, exchanges themselves start monitoring transactions. So if there are a lot of peer-to-peer transaction or activities come through unregulated exchanges, this will be flagged as suspicious activities. So that's something we need to sort of keep in mind as well. Okay. So my last point is, okay, they are increasing availability of tax calculation tools to facilitate the reporting of cryptocurrency gains. But inherently, that still results in some risk as well, because as you understand, cryptocurrency tax itself is more complex than normal taxation. So there's various different type of transaction has different tax treatment. In terms of cryptocurrency, you have airdrops, fork income, lending income, margin trading, derivative products, some of these DeFi transactions. Each of them has different tax treatment. Some of them will be treated as income, some of them will be come under capital gains tax. Your cost basis will be different. So even if you use a tax calculation tool, you need to make sure that you understand correctly code these transactions so that your tax calculation is accurate. And in terms of looking at this scenario and reconcile your balance as well. Once you upload the data, yes, tax calculation helps you to gather the information from various exchanges and wallets. But once you upload the data, you need to make sense of the data, and you need to reconcile your information back to your ledger wallets and see if there's any missing information. And if there's a missing information, how you rectify these. In crypto world, it's very common. There are some exchanges went bust or they haven't kept enough record. In this scenario, how do you handle this situation? So you need to sort of have an understanding to rectify these missing information as well. And especially another risk is if you are doing your tax return yourself, there are certain tax planning measures individual can sort of utilize to minimize their tax affairs. Things like utilizing your personal allowances, using loss harvesting strategies to kind of look at through the 30-day rules and take advantage of these. And things like advanced tax planning, like you utilize your personal pension contribution, EIAs, and other tax efficient opportunity which will provide a tax advantage. So if you do your tax return on your own, the individual might be losing out on some of these favorable tax advantage, which will be missed out. I think that's kind of 4 points I would like to cover in this space. There's so many other questions, but I thought these are appropriate for our conversation today. Thank you, and I'll pass it on to you.
Thank you ever so much, Shukry. And yes, you could probably discuss some of these nuances for many hours, and tax is not a simple thing, even for those experts in the field. That it's such a moving target, and so that's very informative for the community at large. And thank you so much. And if you do have any questions, or you don't know how to report perhaps a gain or a loss of Binance and cryptocurrency, then please seek a professional advisor such as the folks at cryptotax.co.uk. All right, well, that moves us nicely into our final speaker, So without any further delays, if I could then pass over to Mitchell Stein, please.
Okay, so I just need to, can you unshare your screen? Okay, so let's see that. So thanks, Ian. I'm going to talk briefly about the sort of the global transparency challenges of crypto assets, and sort of tie together a few of the themes the other panels have been talking about. First of all, it's, as the other panels have mentioned, crypto assets are a rapidly emerging area with I think it's important to note widespread and growing use. So it's not just limited to right, a small number of more sophisticated users or taxpayers, but a broad group of individuals. And there's an inherent nature of cryptocurrency assets that just leads to concerns over opacity of these. That these are not as transparent as perhaps some other tax issues or mechanisms and assets or types of income. There's a lack of centralized control here. We have valuation difficulties, and there's potentially hybrid characteristics. Most of these, I think, could be seen as intangible assets, but they could be, in some places, considered more as a financial instrument. So what are they? And we just have this rapid technological evolution, and people keep giving new names to these things. Are they currencies? Are they assets? And different jurisdictions may treat these differently. As Dion mentioned, right, the OECD has a recent report out here around taxing virtual currencies, an overview of tax treatments and emerging tax policy issues. So this report is trying to understand on a broad country basis how different countries are treating these, and recommends here that the solution around more transparency, as the OECD points towards, improved guidance and communication of how virtual currencies fit within existing regulatory and tax frameworks and policy objectives. Now, what the challenge here is that every country has its own regulatory and tax framework and policy objectives. So everyone's trying to do something perhaps a little differently at times, though there is obviously some commonality into what's happening. We did, as you mentioned, done some work on the base erosion and profit shifting of the recommendations around the OECD. And this is where, again, there's a concern that large multinationals were trying to minimize, right? So a lot of the issues here are taxpayers trying to minimize the amount of tax they want to pay. And that's just a natural inclination. And how do tax frameworks allow for that, given that these are global and people might be, it's not just limited to one country. So there's various frameworks that people are dealing with here. That in these cases, we've played more disclosure. We've done more country by country reporting, but the thing to recognize that in some of the OECD work, OECD work, is that this is soft law, right? So it's not that you must follow this. It's really just recommendations, and countries must buy into this. And the question is, does it provide clear answers for taxpayers, which some of our panelists have mentioned? And many tax authorities, I think that in this work we noticed, rely on the court of public opinion that you need to pay more tax, or we are, at least this was, not all countries, but at least in Canada in particular, we noted that we don't care if it's right or wrong, but what does the public think about this? And this creates a difficult environment for taxpayers to work in. Challenges around virtual currencies. Again, are we dealing with soft or hard law? And I think the issue here is that there's a need for clearer hard law around virtual currencies, because there's people, I think taxpayers want to know what they should be doing. There's a lack of standard definitions of even what virtual currencies are across jurisdictions. And so we need, I think, and this is a really challenge, but more coordination and uniformity across jurisdictions. So I think countries need, this is not a natural inclination for tax authorities, right? Every tax authority wants to make sure that their tax base is protected and meets their policy objectives. So it's something we definitely need to keep working on. I think understandability is key given the widespread nature of users. We're not talking about large multinationals here who might be very sophisticated, right, taxpayers with large tax departments that can deal with these issues. We're talking about, you know, many folks who just don't, you know, and tax is not their area and of expertise. And I think for us who practice in the area, it's very natural, but it's not for many people. Record keeping and tracking, right? How do we do this? Is this a new form of a cash business? I mean, for decades and centuries, you know, as long as tax has been around, people say, well, can I pay you in cash so I don't have to declare this or something? So how do we keep track? How do we keep track of the records and manage this whole process? The last thing sort of I would bring is then, well, how do we achieve compliance around this area, and some thoughts regarding that, and particularly sort of bring in some academic notions here that we might want to think about. First of all, there's this notion of a regulatory pyramid. Braithwaite talks about this in her work, going in 2000. There's a number of papers and discussions around this. But, you know, is self-regulation. Most taxes at the bottom of the pyramid where we find compliance. And as people have mentioned, through education, records, and reminders to people that they need to comply with their tax responsibilities. Here we have a slightly different mindset around where cryptocurrencies have come from. So this poses some real challenges. And so do we require more command regulation, sort of clear, understandable, hard law that we must comply with? And this is something that tax authorities such as HMRC are going to have to think about. First, again, easy, simple, understand rules rather than broader conceptual frameworks. I think we need to go there. It's easy for us to move to frameworks, but I think having clear rules in some cases might be better. We need to think about taxpayer culture. Culture is important. For our there's work around perception of fairness and role of comparison groups. So if you see someone not paying tax on their cryptocurrency transactions, and this seems to be the broad culture it's created, you may say, well, I don't have to pay tax, right? And how many people are actually complying is a good question. So creating that culture is important. Obviously, necessary resources and commitment to enforcement is critical. There's certainly, where do we place resources in a country? Where do we place resources within our tax authorities, and how do they use those? And how do we enforce these transactions are critical. And finally, required disclosure of cryptocurrency asset holdings. Over the last decade or two, at least in Canada and the US, I suspect in other countries, taxpayers have to actually declare when they have things like foreign bank accounts and foreign holdings, so we can track offshore, right? This is how we're getting at offshore transactions within North America. And so do we now have to have another question saying, what do you have as your cryptocurrency asset holdings? And this is something we need to think about. So there's a few thoughts that I would like to share. Thank you very much.
Thank you, Mitchell. That was super interesting from a viewpoint from 40,000 feet down into the challenges facing both the regulators, policymakers, and the industry at large. And it's obviously not something that we're going to solve right here, right now, today, but some really interesting, thought-provoking thoughts. And a general thank you to the panelists for presenting your topics. And what I'd like to do now is ask a handful of questions presented to us by our members in the community. So let's start with the UK. And as the panelists have mentioned, we've seen a number of clarity policy pieces out of the UK, whether it be the crypto asset promotion, consultations just closed within the last week, whether it be the KYC and ALD regime that crypto businesses need to apply for. And then finally, we just saw the ban of the wholesale prohibition of retail derivatives and exchange traded notes in the UK. So just if I open it up to the panel, if anybody has any thoughts around whether they think that individuals and or corporates, the industry at large, do they understand their obligations and what is required of them in the UK?
Thank you for that, Ian. That is a great question, and I would say that that is probably the million-dollar question for ourselves at HMRC. Do people understand it? And if they do understand it, why are they complying with it? And if they're not, why not? As Mitchell was alluding to, there is already a culture in some countries with non-payment of taxes as being almost, should we say, routine. Certainly, I don't think the UK is one of those. As Josh is mentioning here, the tax does seem to be a pressing matter for the exchanges. And I think many people are still looking to the exchanges to provide that level of education, that level of understanding that's necessary for them to actually be able to do what they need to do. And totally, as Shukry was also saying, he's having customers coming to him that are highlighting some of the questions and some of the points that, I have to say, my very first webinar in 2018 seemed to keep coming round. So there still does seem to be a level of education that's actually need to help people understand what they need to do. And how we meet that challenge isn't just for HMRC. I think that is for industry, academia, as well as the accountancy profession.
Thanks, Dion. Perhaps I could bring in Shukry just quickly, in the work that you do in the community. How's your sense around whether folks that you work with understand what's required?
From a consumer perspective, yes, they have more knowledge now that they need to comply with money laundering legislations, because most of the prominent exchanges are forcing the client to do the KYC, and sort of they do the ID checks. And we have seen many instances where failure to do any KYC, they have sort of freeze account or close account. So they are taking the initiative. Interested to see how these legislation after 6th of January next year span out. So effectively, we will have two type of exchanges. One will be complying with the regulation, and the type of exchanges which is not complying with the AML compliance. So interested to see if the exchanges themselves track any of these activities which come through a non-regulated platform, will be flagged as sort of a risky transaction. So that's one area to sort of impose more and more compliance from an exchange perspective, so that we will have a higher number of compliant platform and only few outliers which are not part of the money laundering compliance.
Mm-hmm. Thank you. All right, well, the second question raised by the community, and this is to Josh's point we touched on earlier, the murky world, murky, that's not the right word, or let's call it the new developed world of decentralized finance, commonly known as DeFi. And we've seen over the summer a large explosion in the volumes and transactions and the monetary value that have occurred. And just for those of our listeners that are new to this, DeFi endeavors to disrupt mainstream financial services such as lending, asset trading, payment services, and insurance, to name a few, by automation, operating without a central authority. DeFi has experienced enormous growth this year. The numbers that we pulled from DeFi Pulse in October 2020, current numbers are looking like $12 billion of transaction volume. So this has really, really increased exponentially over this year. So if I could just open up to the panel, maybe start with you, Josh, because you touched on this. What do you think regarding some of the substantial gains perhaps made on a decentralized exchange, where said exchange has no jurisdiction, has no individual that can be identified? I'll give a quick example. Uniswap, as members of the industry will know, is one of the largest decentralized exchanges, also known as DEXs. However, we can find out where they are because that received venture money, but then recently there's been a fork of this exchange to SushiSwap, and that particular automated marketplace is completely decentralized. You could not enforce on that exchange if you were an agency. So Josh, do you have any sort of thoughts as to how we could tackle these issues in the industry?
Yeah, no, it's a great question, and it's extremely challenging, I think, for everyone in terms of how do you keep up to speed, with these kind of developments, because DeFi has kind of gone leaps and bounds. It's doubled the amount of assets, or what they call total value locked within the DeFi community. So the size of the DeFi market has increased almost exponentially this year. Whether it continues to increase at this pace, I think is another question. There are diverging views on this. Personally, I think DeFi will continue growing, but not at the pace that it was previously, because that was all really led by the income that you could generate from participating in various experimental, new, and as you say, in many cases, slightly opaque DeFi services and products. Now, there are all kinds of interesting case studies or scenarios to look at when you scratch the surface of DeFi. I'll give you one. This came from a client of ours that was interested in discussing with us our view on all of the various DeFi products that involve, I referenced it earlier, automated market makers, AMMs. So you provide you stake almost your asset within a pool, and you get a reward for staking your assets in that pool. And the purpose of staking assets in the pool is so that if anyone turns up and wants to buy or swap an asset of some kind, that the liquidity for that underlying trade or swap comes from this pooled set of assets. So the client came to us and said, what are you guys, what are you seeing in terms of the regulatory space around this? How do you view these things? And we said, it really depends on the actual underlying product itself. So one example, participating in an automated market maker scheme can involve a trade between two counterparties. It goes from your wallet to a locked smart contract. It looks like a trade, it feels like a trade, but technologically it's not a trade. So what's the taxable event from a personal income perspective there when you're placing your assets out of your control into a decentralized wallet of some kind, i.e. a smart contract, to be able to generate some kind of income from that? It's not a typical trade, it's not for trading purposes, but you are handing over the title, or you're at least handing over the control of what was your asset now into a pooled omnibus wallet that usually takes its shape in that of a smart contract. Where's the taxable event there? So I've just given an example of one of the many nuances that exist within the DeFi space. And I think these throw up challenges. And we were having this roundtable with this institutional client, and we didn't have a good answer to that question at the time. And we certainly never give tax advice, but it's really interesting for us to kind of get these scenarios out in the open with people and really try and creatively problem solve and talk about these things. So that's just one example, I think, of some of the challenges that DeFi throws up, in that people keep building these innovative systems that do things in new ways that we previously haven't contemplated.
Thanks for that, Josh. And I think that plays into the presentation that Mitchell gave, where there's a lot of work to do both in the public and private sector to work through these new challenges, because this is completely new, whether it's a new asset class, whether it's a completely new, well, it is a new technology, that brings with it a whole host of issues for us too, both in the industry and the policymakers to work towards. All right, we're going to sorry.
Quickly add there, Ian, that you don't think also this in an international framework. So it's not just one country in the UK, but you could have multiple jurisdictions. So all of these issues and how they're treated are different across various jurisdictions, which even makes it more difficult. And sort of indicates that we should think about simple, to the extent we can, trying to simplify the rules as much as possible.
Thank you. All right, let's move on to our next question. This is in regards to charitable donations. So we're starting to see some growth in crypto assets being used as a donation. A number of exchanges are partnering and offering through third parties donations of crypto assets, and we also know that Binance has its own charitable foundation, as Josh mentioned earlier. raising a lot of money for good causes. Now, the pandemic has unfortunately resulted in the cancellation of many mass events, such as the London Marathon, which last year raised some £66 million. Right now, charities are probably looking to when they will be able to hold these mass events to recoup some of these losses this year. And I just wondered what the panel thinks around the different jurisdictions' treatment of donating certain property. In the UK, crypto assets are considered property. You cannot make a donation in the UK and receive a taxable benefit, whereas in the US, you can make a donation of crypto assets and offset that against your overall tax liability, thus incentivizing the community of holders of crypto assets to make donations to good causes. So perhaps if I bring in Dion first, do you have any thoughts around crypto asset donations?
Well, I think the first bit to remember is that, as already in our guidance, that you can actually make charitable donations with crypto assets. We might not treat it in the same kind of way as you're saying about a tax benefit, and I have to admit I don't know enough about the US legislation to understand quite what that benefit is, but you can still make a charitable donation, and that's in our individuals paper. I think we've also seen some very recent cases where it's the charities themselves also might feel that they might not want to accept a donation. So what actually happens there? Because there have been some charities that have been sent crypto, but they're not able to obviously reject it without having accepted them first. And there is a concern that they could become from money laundering. So I think there also has to be some questions about how do we ensure that the market is suitably safe for charities to be able to accept these donations without somehow falling into some form of criminal money laundering investigation as well.
Thanks, Dion. No, it's worth considering that it is such a new form of property or asset class that we have to work with industry and partners to help folks if they want to donate and charities receive that. Does anyone else on the panel have any thoughts around donations?
Yeah, I just want to sort of point out, yes, you could donate crypto as charitable donation. What that means is from a tax perspective, it will be considered as a taxable event. So the market value will be considered as a disposal proceed. So if you have acquired the asset at lower cost, any gain will be chargeable for capital gains tax. And for charitable donation, anyway, you could take advantage of like paying tax at lower tax band, because like any taxable donation will increase your personal allowances from the amount what you're contributing. So instead of paying at a higher rate, you may be able to pay the taxes at lower tax band for capital gains tax. So there are still some advantage, but obviously the gain is taxable.
Mm-hmm. Yes, and it's worth adding that we won't quite go the same distance as listed shares would be, because we would obviously have to have the same kind of regulatory protections that they actually have. Again, going back to the point I made before, to make sure that the charities aren't somehow caught up in some tax avoidance scheme or other event to try to artificially reduce people's tax bills. So I think we've got a little bit of a way to go.
Yeah, makes sense. All right, well, I think that draws us to the end of this enlightening session. Firstly, thank you so much to our panelists. And perhaps if I could ask you folks for some contact details, if anybody wants to reach out to you, or where can you be found, Josh?
Thanks. Yeah, I can be contacted more or less night and day. Unfortunately, on Twitter, I'm at Josh Goodbody, and we've got various Binance platforms there that you can engage with. We're open book; anyone can reach us at any time. Thank you.
Shukry, if anyone wants to reach out to you for advice?
Yeah, you could sort of reach out to our website, mycryptotax.co.uk, and yeah, you could sort of find out our contact details from there.
And Dion, if anyone wants to engage with HMRC, well, where should they go?
Obviously, we've already got telephone lines for individuals if they wish to phone, if they have questions, phone those lines, and if the question is suitably difficult, then yeah, you might end up getting input from me. But as it stands, the telephone lines are the first protocol.
Terrific. Well, thank you very much, everyone. Have a good day, and thanks again.
Thank you, Ian.
Thank you.
Thank you all.